At a time when a recessionary cloud is hanging over the US economy and beyond, the US Senate is putting on a table a generous funding package for the technology sector, especially for semiconductor manufacturers. And understandably, speculative inspectors got the message and attacked the Wall Street dashboard. The $280 billion financing plan aims to first stimulate domestic production, with a distant hope that imports and dependence on Asian markets will be reduced. In fact, the $52 billion will go directly to investments in companies' fixed assets, while another $170 will go towards research and development. The industry welcomed the bill, as companies such as Intel, AMD, Qualcomm and TSM will use it for the continuation of their operational activities and their long-term expansion. However, a deeper analysis shows that the winner in all this sharing will be Nvidia, as it is the leader with the best market position, and its recent achievements in the technological field suggest that it will keep the leading role. Given the positive impact in the medium term, both on psychology and on the expected benefits of the bill, the technology sector outperformed with a poor plus 4.29%, which was surprisingly lower than the plus 5.11% of the telecom sector, thanks to the apparent dominance of Google, plus 7.74% of the Class C share, Meta, plus 6.55%, and Netflix, plus 6%. Indicative of the optimism for the industry was that only 4 out of 76 closed in the negative, and incidentally, 93% closed in a 20-day uptrend, while half of them closed at month highs. Nvidia stock has been pressured heavily this year, recalling that despite yesterday's surge, plus 7.60%, it is still down 40% as of January 1st. And this seems logical, because part of the dominance of 2020 to 2021 and the wonderful 1200% came from the equally outsized growth of the crypto market and the resulting demand from the company's products. For now, it is running a sideways move in the form of absorbing strong rallies, with the upper edge being at $184, a breakout of which would lend a strong bullish rhythm, with the next stop at the $220 area. The risk is looming in case the buyers are not brave and stop the rally, as below $163 we expect a feedback of the bearishness, with a reception zone at $135 being the year's low. And apart from the given dominance of the company on a technological level, the long-term picture in its financial statements is enviable, as it has achieved for 5 out of the last 6 years an average 45% turnover growth. Unfortunately, the trouble started in the first quarter of 2022, when after several consecutive profitable quarters, it saw a severe downturn in net income of 45% quarterly and 15.38% annually at $1.62 billion. Surprisingly, the dividend policy is non-existent, as management still remains focused on investments, with operating cash flows reaching $1.73 billion and the investment cash flows at $2.61 billion. The value to operating profit ratio is 30.77%, with returns on equity close to 42% and on invested capital close to 30%.